Welcome back to part 2 of a brief history of insurance and the incentives that drive it. With that, we're going to jump into a different frame, which is not just what it does, but the philosophy behind insurance. So from a philosophical standpoint, insurance is also a bit of a thinker. A lot of people think about the expansion of free markets. People usually reference a book called The Wealth of Nations. The Wealth of Nations was written, oddly enough, during, I believe, a pandemic back in the 1700s by a man named Adam Smith. Now, what most people know about Adam Smith is that he wrote that book. The more important side is that he wrote a sister book to that, which is The Theory of Moral Sentiments. The idea of free exchange was based around two things interplaying, which is a high-trust society and free exchange of goods and ideas and services. The side of this that Smith wanted to focus on was that without those two things working in conjunction, you end up necessitating or inviting in either regulation or bad actors. And most times you get both. Now, how are we going to focus this on insurance? Well, insurance, by its definition, is a financial arrangement in which a person or entity receives a bit of protection or reimbursement against a big loss. And I'm reading this verbatim here. It involves the transfer of risk of a potential loss from one party to the other in exchange for a premium. Remember how we talked about the walls of Jericho, or a pint of blood rather than a gallon. You're paying a little bit so you don't die. Okay. Now, the effect of this was that it cuts to, in my opinion, one of the baselines of humanity. We value loss 7 times as highly as we value gain. Now, you can test this on yourself or on someone that you want to chat with and ask them, if I called you at 3:15 in the morning and said, Bob, I need you to act right now, and I can make you $1,312, right? Now, at that point, or $312, let's use a lower number, $312. At that point, Bob is going to say, it's 3:15 in the morning. Why are you calling me? Pitching me some idea. Most of the time. Now, the opposite frame is if you call Bob at 3:15 in the morning and you say, Bob, if you don't act right now, you're going to lose $312. It's a completely different reaction, even though the exchange is the exact same. It's the exact same situation, right? But people act much more strongly to the protection against loss, to the evaluation of gain. And folks, that is the philosophical part that insurance represents. Because we are loss averse as a species, we need a vehicle that assuages our fears and allows us to move forward. And insurance is that vehicle. Insurance, in so much as it is pooling of risk and it is the pint of blood for the gallon, it's also a philosophical piece. It makes people comfortable with the idea of additional risk. And if people are comfortable with additional risk, they take greater action, they build cooler things, they develop greater technologies, they allow the modern world. I know I'm a bit biased, but I'm also in the insurance business, right? So if you don't love what you do, do something else. All right. We talked about, in the last video, types 3 and 4 of spending. And again, this is a philosophical standpoint, or a little bit of, this is Chicago school economics, and I believe it also ties into the Austrian school. Not so much with the Keynesians out there, or the modern monetary theorists, but in an old school or a main vein of economics, classical economics, this is the way in which you see spending. There are 4 different utilities. Now, keep these in mind whenever we think about insurance. There is the money that you have that you spend on yourself, and that is the most efficient in terms of value delivery of any of the monies. So the most efficient dollars that people use inside of a health plan are the dollars that are theirs. They are more likely to go shop for a lower deductible than they are for a lower surgery cost, because the surgery cost doesn't affect them. The deductible does. Number 2 is money that you have that you spend on someone else. Now, the money that a parent spends on their child is less efficient in terms of value delivery. I'm not making a moral judgment here. I'm saying this is just a reality of life. That whenever my son is sick, or if he has something wrong with him, I open up my checkbook much more quickly than I do for myself, right? I value his utility much higher than I value my own. And I think that's the nature of good humans. Now, the third type of money is where insurance, in terms of loss, most of the time lives. And that is money that someone else has that you spend on yourself. Now, the third type of money is generally how self-funding works. Now, someone else has. The theory of moral sentiment says it has to be inside of a social group, right? That social group is the tribe, the place, the city, the nation. The higher the cohesion, the less likely you're going to get the sociopaths in there that manipulate and game the system for their own benefit at the expense of everyone else. That is the third type of money. The more you get to an efficient third type, the more efficient the entire system becomes. That's why self-funding is so effective, because it is part of the pooled risk of money. The further you get away from that, the closer you get to the fourth type of money, which is either government money or money that someone else has that's spent on someone else, which is also called the fully insured market. Inherently, inside of that, there is less accountability because the incentives are further and further eroded. The closer the incentives are to type 1, the more efficient the dollars are. The closer the incentives are to type 4, the less efficient the dollars are. This is the nature of Milton Friedman. I believe he won the Nobel Prize for this. This is the nature of this idea that works. And you can prove it whenever you go out to dinner. So for those of you who are listening to this conversation saying, Tom, you're wrong. Not only are you wrong, you're completely opposite. Do yourself a favor. When you're going out to dinner with, let's say that you go out to dinner for yourself, what do you normally get? Well, I'm a cheeseburger and a Caesar salad type of guy, right? Whenever I'm going out to dinner and my wife orders something, I am much less likely to look at the cost of what she's ordering than myself, right? It doesn't matter as much. It's for her. It's her business. If she wants to get a scallop salad with, something expensive, that's fine. Now look at the third type of money, which is whenever you go out with let's say a vendor, or let's say an uncle that you don't really like that has a ton of money. What are you buying? Well, you're not buying a cheeseburger and Caesar. You're buying beef Wellington. You're buying something more expensive. Now, the utility of that is very low in terms of greater utility. There's greater flavor. But the actual utility of a cheeseburger and a Caesar salad compared to a beef Wellington is actually very close. So there's a little bit of a flavor difference, but the cost difference is massive. And the final type of money is one in which the money itself actually is a vehicle. It doesn't actually communicate value as well. And that's the fourth type. So think about government meals. They're extremely expensive and they're low quality, right? If you go to a public school, go to your kid's school and get a lunch meal, it's going to be quite pricey and it's going to be terrible, right? That is the effect of the fourth type of money. The further you get away from the incentives that matter, the less accountability you have. The hard problems. There are a couple of problems that are going to pop up. And for you thinkers out there, this is going to be the balance. As people become more detached from the idea that the cost of insurance is due to the consumption of the goods that are run through that pool or that plan, then they are convinced that they're entitled to it. But the more money you spend on something, the more likely you are to say that I deserve it. It's called the actuarial death spiral. But it goes against one of the things that's fundamental for humanity. We need this. If you look at the image on the left side, we need this image for humanity to advance, to produce. We have unlimited wants. We have limited resources. That tension, that fulcrum there in the middle, is how we get innovation. That fulcrum is how we pull things forward. It's why we developed metal plows rather than wooden. It's why we developed the internet so we could communicate more easily and quickly. This tension is what allows humanity to come forward. It's also what makes people feel like they're entitled to things. We need this tension. It's both good and bad. Like everything, there's only trade-offs. So if we carry that with one other piece, which is we need a society, or we need a system or a plan or a pool that does not encourage overconsumption or encourages the people to be prudent in their consumption. So if we take these two pieces and we put them together, we get self-funded, which is every man shall bear his own burden, right? Now, I'm quoting a little bit of historical wisdom. It says that every man is only responsible for two things, himself and everyone else. And that is the idea that are played right here if you think deeply about it. We have both sides that we need to play well with together. Now, who does this extremely well? Well, for those of you who know me, you know that one of my other businesses is working with the Amish, and they are incredible people, and they are incredibly efficient. They also are truly self-funded. When I mean truly self-funded, I mean no stop loss. They are truly self-funded. And so they realize that whenever they have a big claim, the entire community is paying over a certain point, over a certain threshold. And now they can either pay in cash or they can pay in labor. But they're paying something. If you're part of the pool, you're on the hook for Bob's claim, period. Now, it's also why there's such incredible turnarounds on the way that they do things. And I'll tell you a quick story. One of the communities that I work with is Jamesport, Missouri. And in Jamesport, recently they had the general store burned down. Now, that was a big loss to the community. It's where most people bought their flour. It's where most people bought most of the home goods. It was the big store. So I was chatting with a buddy of mine and said, man, that's terrible. What can I do to help? Well, would you mind printing some flyers? I said, printing flyers? For what? It took them 3.5 weeks to go from a completely burned down building to completely reset up because everybody's incentives were aligned. The longer the building was closed, the more everybody had to pay. So everybody got to work, and they got to work very quickly to protect themselves and their community. That is the most effective that I've seen type of self-funding for a community aspect. Now, it only works at small scale, so you still have to have things over the top, in my opinion, like reinsurance and stop loss for the big claims that group of people cannot actually carry. So whenever we think about insurance and the philosophy of insurance, we have to think about the 3 types of money. We have the individual person's deductible. We have the family's deductible, which as a parent, you're less concerned about. And then the 3rd type of money, which is when the pool of assets from that group of people from a self-funded plan are then used to pay for the members of that group. When you go over that, you start to erode that, and you go to a different type of money. But this right here is the philosophy of why self-funding actually works better from a consumption and a value delivery standpoint than fully insured or governmental programs. That 4th type of money is, at least according to Friedman, and I agree with him, the worst type of money to use. And that's why you get more and more government inefficiency or large system inefficiency whenever you have less and less accountability. All right. With that, we're going to jump into part 3 here in just a minute. I hope you enjoyed so far, and we'll see you in a minute.